Hello and welcome to Session 8 of the Basic Tax course. We're going to begin Session 8 with a review of the Session 6 quiz answer key. And I'm just opening up the Session 6 quiz in front of you right now and the most frequently missed questions. We're going to begin this time with question number 7. Qualified student loan interest includes interest on loans that paid for room and board, books, tuition and fees, or E, all of the above. And E is the correct answer. Students have missed this question for years and years and years. They always get hung up on the room and board issue. But if you recall back when we were discussing the deductibility of student loan interest, I went out of my way in that lecture to point out that student loans that are used to pay for room and board, the interest on those loans does qualify for the student loan interest deduction. But of course, you do not get to claim a deduction for the cost of room and board when you're talking about education expenses. It is only the case that if you take out a student loan and proceeds from that loan are used to pay for room and board while you're at school, that is an allowable use of the money, and therefore interest on that loan is deductible. The next most frequently missed question is question number 8. A taxpayer can contribute money to his or her spouse's IRA whether or not they file a joint return. That is false. It is necessary to file a joint return if you wish to make a contribution to your spouse's IRA, and essentially that is because the spouse has to be able to show that they had compensation on their tax return. So ultimately, if you're making a contribution to their account, and you want to claim the deduction on your return, you're going to have to file a joint return with them. And if they want to be able to make a contribution to their account and file separately from you, they would have to have compensation showing on their return. So it's essentially what's going on there. You can read more about this in Publication 17, page 1T1. And moving on down, we have the next item in line, 16. The due date for contributing to a SEP or simple IRA plan is the due date of the return, including extensions. And of course, most students select due date of the return. If you are talking about a traditional IRA or a Roth IRA, it is necessary to make the contribution by the original due date of the return, not including extensions. But when we're talking about simple or SEP IRAs, you do have until the due date of the return, including extensions, which is generally October 15. Number 17, you can claim a deduction for alimony paid on either Form 1040A or Form 1040. I don't know why students miss this one because, no, you cannot report alimony on the short Form 1040A. That does kick you onto the long form. Next question in line, number 19. Per your divorce decree, you must pay the entire mortgage payment on a home you jointly own with your ex-spouse. Your payments are partially deductible to you as alimony. That is the true answer, A, and this is also something I discussed in our lecture. Essentially, the way it works is if in the divorce decree you are ordered to pay the mortgage in full on a house that is jointly owned by you and your ex-spouse, then in effect you are making payments on property that benefit your spouse that aren't owned by you. And because you're being directed to do that by the divorce decree, it is considered to be an alimony payment. And of course, you will find more details about that in Pub 17 as well. Number 21, the 2010 health insurance deduction for the self-employed is what percentage of the total insurance premiums paid? Well, the only answer here that's any truth at all is 100%. Of course, you have to have net income from self-employment. And if you do have net income from self-employment, then you are allowed to deduct your health insurance premiums up to your self-employment income. But it's really the self-employed health insurance premiums themselves are fully deductible. There is no limit on how much you can deduct other than the fact that you cannot claim a deduction for self-employed health insurance premiums if you didn't have any income from your business or if you didn't have very much income from your business. The next most frequently missed question in line is the mini problem. Lex Luthor moved to a new job on July 1st, 2010, and his employer reimbursed $500 of his allowable expenses, which included the following: moving of the household goods. Is that a deductible amount? And the answer is yes, it is. Shipping the household pet, is that deductible? Yes, it is. Storage of furniture for 5 months at $100 per month Well, 1 month is deductible, and 1 out of 5 would give you $100 that is deductible. Lodging while driving to the new home is deductible as well, but meals while driving to the new home are not deductible. It also says that Lex drove his car from his old home to his new home a distance of 1,000 miles, and we're going to look at the standard mileage rate that he is allowed to claim, and that is 16.5 cents per mile times 1,000 miles gives us a deduction of $165. Let's take a look here at the finished 3903 for Lex, and you will see that he has allowable expenses that are entered on line 1 totaling $1,850, and where we get that from is the addition right here. $1,500 plus $250 is $1,750 plus $100 is $1,850, and that's where we got the $1,850 on line 1. Then on line 2 we have lodging while driving to the new home was $200 plus the mileage driving to the new home of $165. We totaled those up and entered that on line 2 for $365. So the total moving expenses are $2,215. And then it says how much was reimbursed by your employer, and the problem tells you $500 was reimbursed, so you should have entered that on line 4. And then, of course, the total deduction that is allowed on the return is $1,715. So that concludes the review of the Session 6 quiz answer key. Let's move on now to the next topic, which is a review of the Session 7 homework assignment. And here is Session 7 homework A. Dr. Hewer is single, and he works as a doctor. He bought his first home as a contract sale from Wilma Deering, and during the year he took out a home equity loan to buy a new boat. So that would be home equity interest not used for home improvement or home acquisition, but it can still be deductible. He also took out a home improvement loan that was secured by his home. So he took out home equity loan to buy a boat, and he took out a home improvement loan which is secured by his home. They're both ultimately home equity loans, but one is used for improvement, the other is not. Dr. Hewer has no idea what he can deduct, and he is hoping that you can help him. He had the following income and expenses. On the income side, he had ordinary interest and ordinary dividends. And on the expense side, we have health insurance premiums shown on his W-2. Will he be able to deduct that? No, he will not, because that is already pre-tax. Unreimbursed medical bills, are they deductible? Yes, they are. Prescription drugs are. Mileage to the doctor's office, he will also be able to claim a deduction for that. Sales tax paid on the new boat at the same rate as the general sales tax, will that be deductible to him? Yes, it will be. He also has a 1098 home mortgage interest statement. The loan origination fee used for home improvement on the equity loan closing papers is $250, and he will be allowed to deduct that. Property taxes of $1,200 are deductible. The mortgage interest that is not on a Form 1098 because it was paid to Wilma Deering is also deductible, but it will go on a different line. And then, of course, the qualified mortgage insurance premiums in the amount of $1,188 are deductible as well. He paid an early withdrawal penalty when he cashed out his CD, and he is going to receive a Making Work pay credit in the amount of $400. Here is his W-2 showing $55,000 of income. He has a cafeteria plan at work, and that's essentially being used to pay his health insurance premiums, and he has a retirement plan at work. So here is the answer key for Dr. Hewer. The information that is relevant that you should be paying attention to is that the health insurance premiums shown on Dr. Hewer's W-2 are a part of a salary deferral cafeteria plan. They are pre-tax, so he does not get to deduct these premiums on his Schedule A. He can claim the following expenses: unreimbursed medical, prescription drugs, and the mileage expense. And so his total medical expense that he can enter on Schedule A, line 1, is $2,625. Also, he is living in Clark County, Washington State, and he will be claiming a sales tax deduction. So we are going to figure that he had a W-2 showing $3,975 of withholding, but he also paid some sales tax during the year, so we need to establish which is going to give us the larger number. And to do that, we're really going to have to complete the sales tax worksheet to figure out what his deduction is on his worksheet. And when we do that, we ultimately show that we get a $4,054 sales tax deduction, and that is more than the income tax he had withheld on his W-2. So he will be better off claiming a deduction for sales taxes paid. Here is the completed worksheet. We begin with the amount shown on the table based on his income level and number of exemptions. And for a resident of Washington State with one exemption and $55,000 plus of income, we end up with $677. The Clark County rate, we've told you in earlier classes, was 1.7%. So we divide 1.7 by 6.5 and we get 0.261538, and that ultimately gives us a local county tax of $177. We add in the big ticket item, the sales tax paid on that, and then we're left with a $4,054 deduction that will carry to the Schedule A. Also on the Schedule A, since the loan was used to purchase his boat, is secured by his home, he can deduct the interest on the home equity loan to use to purchase the boat, and he will also be able to claim the points on the equity loan that was used for home improvement. Looking at the 1040 form, we have Dr. Hewer's wage income on line 7, $55,000. We have his interest income on line 8A, $300. His dividend income on line 9A of $300, and that gives us total income of $55,600. The early withdrawal penalty is the only adjustment he has. We've entered that on line 30, and that makes his adjusted gross income $55,525. Now, moving on to the next page, we have itemized deductions that we've entered on line 40. So let's see where those totals came from. We have here the medical expenses on line 1 of the Schedule A at $22.65, but those are less than 7.5% of his income. So ultimately, his deduction for medical expenses is 0. We then look to his other deductible expenses, and here is the sales tax deduction from the sales tax worksheet of $4,054. He also has real estate taxes that he paid on his home of $1,200, and that was entered on line 6. We then have mortgage interest and points that were shown on a 1098 of $500. The interest paid to Wilma Deering needs to be entered on line 11, and that was $6,500. We also had points that are not shown on a 1098 that were on the home equity loan that was used for home improvement, and those are entered on line 12. And then we have mortgage insurance premiums. Those are deductible in full. His income is well below the threshold amount where a phase-out occurs. And so the total interest expense deduction he gets for the year is $8,438. We add up his itemized deductions. They total $13,692. And, of course, that amount carried to page 2 of the 1040 form and is entered on line 40. We go through and do the usual computations, and we get tax of $57.25. He had $5,000 withheld, $400 of making work pay credit, so total credits are $5,400, leaving him with a balance due of $325. The next problem in line was homework assignment number B, and this was the simpler of the two. Angela Biggins is a single filer with AGI of $30,000. She has a 1098 mortgage interest statement showing $5,000 of interest paid. Property taxes were $1,000. She has $3,000 of state withholding showing on her W-2, but we haven't even given you a real W-2 to look at. Simply working from the AGI that we gave you. During the year, she gave the following items to charity. We have a Honda Civic that sold at auction for $1,000. It had a basis to her of $2,000, but of course, because she is claiming a deduction for an item donated to charity, she will get the amount that it sells for at auction is the amount that she claims as a deduction. She also gave cash to her church in the amount of $500, and she has some volunteer expenses. She drove 1,000 miles for search and rescue, and she also has $1,000 of expense for the cost of caring for her search and rescue dogs. So let's move over to the answer key, and the first item to point out to you is that the fair market value of total non-cash items Angela contributed during the year is greater than $500, so she does have to complete Form 8283 and attach it to her return. On that form, she needs to provide a description of the items she gave away, the date they were donated, the date and how they were acquired, her cost in each item, and the fair market value of the item when she donated it, as well as the method used to determine the fair market value. Now, in the real world, you would obtain much of this information from receipts that the clients bring you and by interviewing your clients and asking them to provide necessary information to complete the form. Since this assignment does not provide all of the information necessary to complete the Form 8283, we wanted you to just pretend that you've interviewed Angela and make up some numbers and put them in there. Now, let's take a look at what we've got. So we have the income tax deduction on line 5. We have the real estate deduction on line 6. Total taxes paid on line 9 of $4,000. Mortgage interest of $5,000. And here are the charity items. The total cash charity deduction ends up being $1,640, and the non-cash charity is $1,000. Let's take a look at the 8283 that we completed for Angela. And we can see that we gave to the March of Dimes. Here is a description of the vehicle, the date it was contributed. We made up a date acquired. We have acquired through purchase, the cost, the fair market value, which is ultimately what it's sold for at auction. So, of course, to figure the cash portion of her deduction, we had to take the volunteer expenses, and she is allowed to claim 14 cents a mile for the cost of the search and rescue mileage, and so we get $140 for that. And then to that number, we're going to add the $500 to the church and the $1,000 for physically the cost of caring for those dogs. So that is where we get $1,640 as the total cash contribution deduction for Angela Biggins. So that concludes the review of the Session 7 homework assignment. At this point, please push pause and take the Session 7 quiz. When you are finished with the Session 7 quiz, please resume playback, and we will begin the Session 8 lecture. And let's begin with the Session 8 lecture. Today's topic is miscellaneous deductions, including unreimbursed employee business expenses, office in the home, and work-related educational expenses. This is still a Schedule A topic, but the part of Schedule A that we're focusing on today is job expenses that are reported on line 21 of Schedule A. In general, you will also need to complete a Form 2106 for certain types of employee business expenses, so we will be discussing this form today as well. So let's talk about miscellaneous itemized deductions. Miscellaneous itemized deductions generally relate to expenses you incur as an employee or are related to other income production such as investment or hobby income. The most common items claimed as miscellaneous deductions include unreimbursed employee business expenses for car, travel, meals, entertainment, and education, as well as job search expenses and union dues, tax advice and preparation of tax return, the fees associated with that, safe deposit box rental when the box contains investment property, hobby losses to the extent of hobby income, and gambling losses to the extent of gambling winnings. There is a 2% limit that you should be aware of. Most miscellaneous deductions are subject to a 2% limit. This means you must subtract 2% of your AGI from your total allowable expenses, and you then deduct what is left. The 2% limitation is restrictive enough that most people are able to claim little or no miscellaneous expenses unless their expenses are fairly substantial. And here's an illustration. Your adjusted gross income is $40,000, and during the year, your employee business expenses totaled $600. If you take your income and multiply that by 2%, $40,000 times 2% is $800. So while substantial, $600 is still less than 2% of your adjusted gross income, and this means that your expenses are not high enough to become deductible for you. Here is the first password of the day, and the password to open the Session 6 quiz answer key is ENDOR, E-N-D-O-R. So let's move on with the discussion of unreimbursed employee business expenses. certain unreimbursed employee business expenses are deductible as a miscellaneous itemized deduction on Schedule A of Form 1040. To be deductible, a work expense must be both ordinary and it must be necessary. But an expense does not have to be indispensable to be considered necessary. So I often joke with this particular definition to say that the IRS simply says it has to be ordinary and customary and necessary in your business to have the item. It doesn't have to be indispensable. For example, it is possible to go to work each day and work from the floor, isn't it? You could sit on the floor. You don't absolutely have to have a desk to sit at. You could work without a desk. But one would say that it is ordinary and necessary for a tax preparer to have a desk at their work, and that is why it's a reasonable expense. We're also going to talk about travel expenses. And to claim travel expenses, you must have a regular place of abode in a real and substantial sense. You have a real place of abode or a regular place of abode if all of the following is true. You work in the same vicinity as your claimed abode and you use it while you are doing business. Your living expenses incurred at your claimed abode are duplicated when you are away on business, and you have not abandoned the city in which your place of lodging and claimed abode are both located. You have a family member or members, marital or lineal, currently residing at your claimed abode, or you use the claimed abode frequently. Tax home. Your tax home is your regular place of business or post of duty, regardless of where you maintain your family home. You can claim the cost of expenses you incur while traveling away from your tax home overnight. If you do not have a regular place of business or post of duty and there is no place where you regularly live, you are considered to be a transient, and your tax home is wherever you happen to work. As a transient, you can never be away from your tax home, so your travel expenses are never deductible. So essentially what we're saying here is it is ordinary for and customary for many employees to travel away from home on business. And the question is, when are these expenses for traveling away from home on business deductible? And the IRS says they're deductible if you can show that you have a tax home, so that when you travel away on business, you're leaving your tax home. And essentially, while you're away on business, you're paying for expenses to be away on business, and you're still paying all of the associated expenses for your tax home. That means you're duplicating an expense or having the same type of expense being paid twice, and that's what makes it deductible. Temporary assignment or job is something that is important to make note of. If you want to claim travel expenses, you can do so only if you can show that the assignment is temporary. And if you are temporarily assigned to a job at a location away from your tax home, you can deduct your temporary living expenses as travel expenses. Your assignment must be considered temporary in order for you to claim the expenses. A temporary assignment is one that you realistically expect will last less than 1 year, or actually 1 year or less, and does in fact last 1 year or less. But if your assignment is indefinite, that is expected to last more than a year, or you really have no idea whether it'll go 6 months or a year or 5 years, you just don't know at the time you take the job, then the location of your assignment will become your new tax home and travel expenses are not deductible. So how do you go about determining temporary or indefinite? Well, the IRS has a bunch of rules in place to help you figure that out. If you are indefinitely assigned to a work location, that work location becomes your tax home. You must determine if your assignment is indefinite or temporary when you start work. You may claim temporary living expenses while you are away from home up until the day you first became aware that your assignment has become indefinite or will last more than a year. Members of the armed forces who are on permanent duty assignment overseas are not considered to be traveling away from home, and naval personnel assigned to ships with eating and sleeping facilities are considered to have a tax home aboard ship for travel purposes. If you are on a probationary assignment with the understanding that you will keep your job upon satisfactory completion of the probationary period, then your assignment is considered indefinite for travel purposes. Okay, so let's suppose we have established that you are traveling away from home on business. What happens if you want to travel home on your days off? Well, if you travel home on days off to visit your family, you can claim travel expenses equivalent to what meals and lodging would have cost you had you stayed in your temporary home. This rule applies only if you are assigned to a temporary work location away from your tax home. If your temporary assignment is expected to last more than a year, you cannot claim the cost of expenses you pay for your temporary home or meals. But note, if your assignment away from your family home is indefinite or is expected to last more than 1 year, you cannot deduct any costs associated with traveling to your family home on your days off. However, if you travel away from your tax home to the vicinity of your family home for legitimate business reasons, you can deduct the costs of business travel to the vicinity of your family home. For more information about this specific rule, see Tax Home Different Than Family Home in Publication 17 on page 174. So what we're saying is here, you've traveled from your main family home to a temporary work location. And this work location is expected to last weeks or months perhaps. Weekends come, do you stay in the temporary tax home or do you travel home to your family? And if you do travel home to the family, are those expenses deductible? Well, IRS says you can deduct the cost of traveling home to your family on the weekend to the extent that it would have cost you to stay away from home in the first place. So let's just suppose you're staying in a hotel and you're paying, $100 a night for the hotel. And if you stayed over the weekend, it would therefore cost you $200 to pay for lodging for the weekend, plus perhaps the cost of meals. So let's say after the cost of meals, it would have cost you $300 to live the weekend at the temporary work location. IRS is saying that the $300 that you don't spend staying at the temporary work location because you do come home to visit your family, well, the costs of traveling home to visit your family are deductible up to that amount. So let's say that traveling home to your family means getting on a plane and paying for a ticket to fly home for the weekend. Well, the ticket would be deductible to the extent that it would have cost you to stay in the temporary location. That is up to $300. All right, moving on. So we've established whether or not your travel expenses are deductible. That is, you need to be traveling away from a tax home on a temporary basis. If you can establish that you're traveling away from your tax home on a temporary basis for a defined business need, then your expenses become deductible. But the IRS has rules even within that parameter of what is deductible. So let's take a look at that. What is deductible when it comes to travel? Well, firstly, the trip must be primarily for business. You can deduct all of your travel expenses if your trip is primarily for business, but you may not deduct costs associated with personal side trips or to lengthen your stay for personal reasons. And here is an example. You travel to Hawaii for a convention, and the convention lasts for 3 days, but you stay a whole week to enjoy a short vacation. You may deduct the cost of traveling to and from Hawaii and the costs associated with meals and lodging surrounding the convention, but the costs for meals and lodging you incur during your additional vacation time are not deductible. So what if the trip is primarily for personal reasons? Well, if your trip is primarily for personal reasons, you cannot deduct any of your travel expenses. If you incur direct expenses while on your trip, you can still deduct those, however. So here's an illustration of that. You travel to Hawaii for a week's vacation, and while in Hawaii, you attend a one-day seminar related to your business. You cannot deduct any of the costs associated with travel to or from Hawaii, and you cannot deduct the cost of lodging or meals while you are in Hawaii, but you could deduct the cost of attending that seminar. So how is it that you decide whether a business trip is primarily for personal reasons or primarily for business reasons? Well, the facts and circumstances around the event really establish that. If you travel to Hawaii, for example, for a full week, and all you do is attend a half-day seminar, there is no way you're going to swing that as a business trip. But if you do sign up for a legitimate training program or your employer sends you to a training program of some kind or a business meeting in Hawaii, and you can show that for 3 full business days you were locked in rooms conducting business, you're going to be able to show that it was necessary to go to Hawaii for that purpose. So those are the types of things that the IRS does look at. They also look at the percentage of time devoted to personal activities and a percentage of time devoted to business. And clearly, if you stay a full week in Hawaii for a business trip that could have been 3 days long, you're beginning to push the envelope there, but it'd probably fly. But if you travel to Hawaii for 2 weeks and attend business for 2 days, now you're pushing the envelope again. So really, one of the true tests is you should be able to show at least half the time was spent on the business activity, or at least the majority of the business week was spent on the activity. Those are the types of things that IRS would look at. Now, what about the costs associated with bringing friends or family members with you? Well, sorry, you're not allowed to deduct any of these costs, and it doesn't really matter what the business purpose is in bringing them. Even if your employer requires that you bring family members with you, it's still not deductible. Now, here is an illustration. You travel to Hawaii to attend a 4-day seminar. Your spouse decides to travel with you. Because of a package deal, you're able to purchase the cost of staying in Hawaii for 7 days is the same as the cost of staying for 4 days. You can deduct all of the costs for travel, meals, and lodging for yourself. You cannot deduct any cost associated with bringing your spouse with you. And this is true even if your spouse assists you in performing your job duties. Let's take a look at meals next. Meals are a favorite item that people try to claim as an expense, and really the IRS defines a meal per se as the cost of eating because you are away from home on business. If you purchase a meal locally within the area in which you live, that's typically not defined as a meal expense because it has to surround an activity of some sort, generally referred to as entertainment. So we'll get to that in a minute. For now, we're going to look at meals in terms of travel expense. And IRS says that unless you meet the rules for business entertainment, you cannot deduct the cost of meals unless it is necessary for you to stop for sleep or to rest to properly perform your duties. Your allowable meal expenses that you can claim include the actual cost of meals, or if you are traveling away from home, you can claim the actual cost of your meals or a standard meal allowance. The standard meal allowance covers the cost of your daily meals and incidental expenses while you are traveling away from home on business. Incidental expenses include the costs for fees and tips given to porters, baggage carriers, bellhops, hotel maids, stewards or stewardesses. It also includes transportation between places of lodging or business and places where meals are taken if suitable meals can be obtained at the temporary duty site, and mailing costs associated with filing travel vouchers and payment of employer-sponsored charge card billings. However, incidental expenses that are a part of the meal allowance do not include expenses for laundry, cleaning, and pressing of clothing, lodging taxes, or the cost of telegrams or telephone calls. There is a way that you go about figuring the daily per diem amount that is allowed for meals, and it is through CONUS. The standard meal allowance varies depending on what day, hour, region you are staying in. The daily per diem rates for travel within the United States, or CONUS, which is the continental United States, the standard meal allowance varies depending on what city or region you are staying in. The per diem rates are revised each year on October 1st. For the last 3 months of the year, taxpayers either use the per diem rates effective October 1st of the preceding year or the revised rates effective October 1st of the current year. They must use either the current rates or the revised rates consistently for all travel during that period. So the standard rate for most areas of the country for all of 2009 and 2010 has been $46 a day. And IRS has a publication 1542 that does list rates by region for high-cost areas. So essentially there's one general overall standard meal rate for all of the United States, continental United States, and that is $46 a day. But you may be able to claim a deduction that is more than $46 a day if you were in a high-cost area. And you can go to publication 1542 for a list of the high-cost areas and the applicable rates that apply to those high-cost areas. Higher rates are $51, $56, $59, $61, $66, or even up to $71 a day that may apply. And examples of special per diem rates for high-cost cities are as follows: Los Angeles, Seattle, Las Vegas, Chicago and Washington, D.C. are all considered to be high-cost areas that qualify for a full $71 a day rather than the normal $46 a day. Now, there is a special per diem rate that is in place for transportation workers. Transportation workers are allowed to claim a higher standard meal rate without the need to track whether they have traveled to high-cost areas. Instead of being limited to a normal standard rate of just $46 a day, transportation workers can use the following standard mileage rates. And depending on what year you're talking about, it does vary, but for both 2009 2010 it was the same. Transportation workers traveling inside of the continental United States are allowed $59 a day, and outside of the continental United States, $65 a day. They can claim these higher rates, or they can claim the lower rate and then track the cities that they're in, but in general, they don't do that. They do track quite well how many days they were away from home, but not necessarily wanting to go through and analyze each and every place. So who is a transportation worker? Well, transportation workers include interstate transportation workers such as airline pilots and flight attendants, train conductors, and interstate truckers as well. Now, what happens if you are traveling outside of the United States? Well, the standard meal allowance for rates for CONUS, that is inside continental United States, do not apply to travel to Alaska, Hawaii, or any other location outside of the United States. So the Department of Defense has established per diem rates for Alaska, Hawaii, and all of the U.S. territories, and you can access per diem rates for these non-foreign areas by following the link that we've inserted in the manual. There are also daily per diem rates for travel to foreign countries, and these vary depending on the country, the city visited, and the month visited. The Department of State establishes per diem rates for all other foreign areas, and for these international rates, please click on or follow the link that we've given you inside your course manual. Now, I'm going to navigate to the internet real quick and just show you the Defense Travel Management Office site. This is one of the links that we've given you. The other link that we've given you in the manual is the U.S. Department of State site. Both of them work, and I'm going to click first on the per diem rate files. When I go there, I'm given a choice of the files that I want to download, and I have chosen the Excel file. So let's just go take a look at what opens when I do that. And it's opening up in Excel for me. And here is the Excel file that I've been able to download from the department site. And you can see that it is arranged by county. And I've just randomly landed on Wyoming with Teton County, this town of Wilson. And you can see here that it's got columns showing different rates. And you'll see that there's a lodging column, a meal rate column, and a local incidental column. We are interested in the local meal rate column combined with the incidental column. And you will observe that if we take the local meal rate column, and let's just go for that Teton County here, we'll see that the local meal rate is $51, the local incidental rate is $5. So if I was to combine those, I would get the meal and incidental rate for that particular county, which is $56 a day. That is $10 higher than the standard rate for the country, so this is considered to be a high-cost area. Here is another county in Wyoming, and you can see the local meal rate there is only $41 a day. If I combine that with the local incidental rate, then I get the standard rate for most of the United States, which is $46 per day. If I care to, I can look at the lodging rates, but I wanted to point out to you that these are not numbers that can be claimed by taxpayers on their individual returns. Rather, these are numbers that employers are allowed to give as allowances to employees if they're requiring their employees to travel away from home overnight. So it's possible that an employee would be given a tax-free allowance to pay for lodging while they're away from home overnight. And these lodging rates are the amounts that an employer can give to an employee tax-free that the employee can use for lodging. But the lodging rate is not a number that an employee can use to claim a deduction. An employee is required to use the actual cost of lodging. However, an employee is allowed to use a per diem rate for meals and incidentals. So it's these two columns that you would be concerned about. Let's just scroll up the page a little bit and randomly just grab another county. I'm going to go with Pennsylvania, Clarion County in Pennsylvania, We have a local meal rate of $41 and a local incidental rate of $5, so that would not be a high-cost area. That's just the standard cost area. But let's take a look at Clinton, Pennsylvania. Here we have a local meal rate of $66 a day and a local incidental rate of $5 a day. That actually makes it among the highest cost areas of the United States, continental United States, giving you a deduction of $71 a day. Now let's go back to the website. I'm going to go back to the main page, and this time I'm going to click on the calculation button. It gives you just a summary of the standard rate in place for most of the country, and there you can see the local meal rate, $41 a day. The incidentals rate is $5 a day, and that's where that $46 a day comes from. Going back again, this time I'm going to look outside of CONUS, foreign travel areas outside of the United States. And what you do is you click on the drop-down menu to select the country that you're interested. You also have to select the date that was traveled, and then click Calculate. And I've just randomly selected Ireland here. And we can see that when you travel outside of the United States, the meal and incidental rates can rise substantially. Here we have Dublin, and the meal rate is $132 a day, and the local incidental rate is $33 a day. So you would be able to claim a deduction for meals and incidental for Dublin of $165 a day. That's a lot more than the standard $46 a day, and you can definitely be of benefit to your clients looking that up. Now, this same information can be found on the U.S. Department of State website, and if you do happen to go to that site instead, we'll just click on the foreign per diem rates by location. And then, of course, you have a drop-down menu for the country. Let's just pick Australia and click Go. And then, of course, it asks you to select the month. It just landed by default on August of 2011 because that's the date that I'm teaching this course. And here we can go and look at Canberra and show that the meal rate is $139 a day. And here they've actually combined the meal and incidentals rate together. If you go to Darwin in the Northern Territory, it's a higher number, $163 a day. So that is just to help you navigate those two sites. And returning to our manual, I've got a summary or example of some of the per diem costs for travel to high-cost areas. And you can see that the first city I've listed is Vancouver, Canada. When we went and looked up the per diem rate for that city, we came up with $120 a day. London in the UK, very expensive, $182 a day. Kuala Lumpur in Malaysia is $77 a day, and Hong Kong, $144 a day. Just as a reminder that when you visit the U.S. government website, you will notice that there are both lodging and meal and incidental rates listed, and the following rules apply to claiming the per diem rates. An employee or self-employed person can use the meals and incidentals rate only. The lodging per diem rates are for employer use only, and you may not claim a standard lodging rate when traveling as an individual. You must use the actual cost of lodging or the cost that you paid for lodging. But an employer can give an employee a daily lodging allowance and a daily meal allowance. So per diem rate for days leaving or returning home, what happens to your daily meal rate when on the day you leave and the day you return? For travel days to and from home for a business trip, you must prorate your standard meal allowance. You can do so by one of the following methods. Under Method 1, you claim 3/4 of the standard meal allowance. Under Method 2, you can prorate using any method that you consistently apply and that is in accordance with reasonable business practice. So, for example, if you had a day of travel where you left at 5 in the morning and returned at midnight, it would be arguable to say that you were gone for all of the hours of the day where you would actually eat, and that, so you should be allowed the full meal rate. And if you wanted to present that argument to an IRS auditor, they might take it. But in any event, they'll certainly take the 3/4 of the normal daily amount for departure and arrival days. So you should use that number with confidence. There is a 50% limit on meal and entertainment expenses. Whether you claim actual expenses or the standard meal allowance, you still have to apply this particular 50% limit. But if you are a transportation worker, the final amount that you calculate for your meal and incidental expenses is reduced only by 20%. So transportation workers claim 80% of their allowable meal expense, while as all other employees claim 50% of their meal expense. The next topic of the day is entertainment expenses. You can deduct ordinary and necessary entertainment expenses provided they are directly related to business or they are associated with business. So what does directly related to business mean? Well, to meet the directly related test, all of the following must be true. You expect to derive income or some other specific business benefit other than goodwill at some future time, but it is not necessary to demonstrate that you actually received the benefit. Also, you must actively engage in a business meeting, discussion, or other bona fide business transaction with the person being entertained, and your principal purpose of the combined business entertainment activity is the active conduct of your business. But it is not necessary to devote more time to business than to the entertainment to meet this particular requirement. So let's look at what it means to have entertainment associated with business, because we have either directly related to business or it must be associated with business. So let's look at what associated means. If your activity does not meet the directly related test, you may still claim deductible expenses if the expense satisfies two conditions. Number one, the activity has a clear business purpose, and number two, that the entertainment directly precedes or follows a substantial bona fide business discussion. This would mean generally within a 24-hour period. However, circumstances can allow for another period of time that might be larger than that. There is a caution here as well. The 50% rule applies to entertainment and meal expenses only. These expenses should be listed separately and are never lumped together with travel or other employee business expenses. So what I mean by that is it's normal and customary for our tax clients to have absolutely no clue about these rules. And so they'll travel out of town and they'll keep track of their travel expenses. And they might say, yeah, my travel expenses for the year were $1,000. And then the next question you should have, okay, what portion of the $1,000 was for travel and what portion was for the cost of meals? And the client will go, oh, I didn't break it up that way. I didn't know I was supposed to. So you as a tax preparer should assume that your client has combined travel and meals together, and that you should then break those numbers apart so that you can apply the 50% limit to the travel portion, or in the case of a transportation worker, apply the 80% limit to the meal portion. Business gifts expenses are the next topic of the day. There is a $25 limit that applies to business gifts. You can deduct up to $25 per year per client for the cost of gifts you give in the course of your trade or business. Gifts you give to family members of a customer are considered to be gifts that have been given directly to the customer. And for a reference on that, you should go to publication page 179. There are some exceptions, though, to that $25 gift rule, and I think this is really rather a silly limit. $25 is such a small number, and I can tell you that it's been around for probably 2 decades, stuck at that limit. I've been involved in tax preparation now for close on 18 years, and it's always been $25. There's been absolutely no adjustment ever for inflation on this number, and it's pretty hard to give any kind of nice gift for $25 or less. Many people do give gifts that are larger than $25, but the gift deduction is limited to $25 per year per person. There are exceptions to the $25 gift rule, and they are as follows. The following items are not included in the $25 limit for business gifts: an item that has a cost of $4 or less and has your name clearly and permanently imprinted on the gift, and is one of a number of identical items that you widely distribute. Examples include pens, desk sets, and plastic cases. Also, signs, display racks, or other promotional material to be used on the business premises of the recipient are not affected by the gift rule. So what would that mean? Well, these are generally referred to as point-of-purchase displays. So it could be a particular booth or stand that's been set up with promotional display items on it, and you give that to a client for your client to use in their business, or you give it to a vendor to use on their business premises, and the IRS says that that does not fall under the gift rules either. Next up is local transportation expenses, but before I get into that, I did want to give you a better illustration of this $25 gift rule because it throws people off all the time. So I just wanted to draw your attention to a quick illustration that I've put together for you. During the year, you gave the following gifts to business clients: Mary 100, Sam 15, Jackie 50, John 25, and George 15. What is your total gift deduction for the year? Well, you're going to need to limit any individual who is over 25 to $25. So Mary would be 25, Sam 15, Jackie 25, John 25, and George 15. Your total gift deduction would therefore be $105. Moving on to the next topic, local transportation expenses. Local transportation expenses are not travel expenses. However, certain local transportation costs are deductible. Local transportation costs include ordinary and necessary costs of the following: getting from one workplace to another in the course of your business or profession when you are traveling within your tax home. So earlier in our lecture today, we were talking about travel expenses away from your tax home, and those are deductible if you can show that you're going away from home on a temporary basis. But local transportation expenses generally are not deductible unless you meet these separate tests. Getting from one workplace to another in the course of your business or profession when you are traveling within your tax home, visiting clients or customers, going to a business meeting away from your regular workplace, getting from your home to a temporary workplace when you have one or more regular places of work. These temporary workplaces can be either within the area of your tax home or outside of it. But as a caution, remember that local business transportation does not include expenses you have while traveling away from home on business overnight. So when is local transportation deductible? Well, it has to be temporary generally. So what is a temporary work location? Well, that is a location that lasts 1 year or less. If you have a regular job location and you commute to a temporary work location in the same trade or business, you can deduct the expenses of daily round trips between your home and the temporary location. If you have no regular place of work but ordinarily work in the metropolitan area where you live, you can deduct daily transportation costs between home and a temporary work site outside of that metropolitan area. And an example of a profession where you would expect that a person has no regular workplace but does generally work in the metropolitan area would be, for example, a construction worker. So a construction worker typically is going to work on one or more job locations in a city in a year, and assuming that it's multiple locations, they'll generally be working in the metropolitan area, but they don't have a regular fixed location. And so what they're saying is, if you're a worker that doesn't have a regular fixed location, but you normally work within your metropolitan area, then you're only allowed to take temporary work location expenses when you travel outside of your metropolitan area. So for example, if you normally work within the city limits of Los Angeles, and you take a temporary work assignment in, say, Orange County, well, Orange County is outside of the normal metropolitan area in which you normally work. It's probably going to take well more than an hour on average to travel from your normal work vicinity to this temporary location. Orange County could be pushing it depending on the commute distance and so forth, but certainly San Diego could definitely be considered outside of metropolitan area. So if you're in Los Angeles and you're traveling to Orange County, where maybe if you're traveling to San Diego for sure, because San Diego is clearly a different metropolitan area. But if you do have a regular work location, let's just say you physically have a normal office location or a normal retail location that you normally work from, but you've been temporarily assigned to a different work location still inside your metropolitan area, the IRS says you can deduct that travel from home to that temporary work location as long as that temporary work location lasts less than a year, actually lasts 1 year or less to be specific. Let's look at what is deductible and what's not. Firstly, commute expenses, driving to and from work within your metropolitan area. Commute expenses are not deductible, and the following transportation is considered to be commute. Driving to a temporary job site when you do not have a regular work location. So for example, I gave you that construction worker example. A construction worker normally would not have a regular work location. So if you do not have a regular job location, you cannot directly deduct or cannot deduct daily transportation costs between your home and the temporary work location within your metropolitan area. These are considered to be non-deductible commute expenses. If you are driving from home to a second job, you also cannot deduct the cost of traveling from home to a second job. But what happens if you have two places of work? If you work at two places in the same day, you can deduct the expense of getting from one work location to another. And if for personal reasons you cannot go directly from one work location to the next, such as a detour to visit your doctor on the way to your second job, then you can only claim expenses equivalent to what it would have cost you to travel directly from one work location to the next. And here is the next password of the day. The password to open the Session 7 homework answer key is London, L-O-N-D-O-N. So here is a table. This really comes directly out of Pub 17, and it does a very good job of explaining when transportation expenses are deductible and when they are not. Let's look at some important definitions that are included in here. Home. This is the place where you reside, and transportation expenses between your home and your main place of work are personal commuting expenses. Here is home, here is your regular place of work, and you can see in between it says never deductible. What is your regular or main job? Well, your principal place of business is your regular or main job, and if you have more than one job, you must determine which one is your regular or main job. Consider the time you spend at each, the activity you have at each, and the income you earn at each. Temporary work location. This is a place where your work assignment is realistically expected to last and does in fact last 1 year or less. Unless you have a regular place of business, you can only deduct your transportation expenses to a temporary work location outside of your metropolitan area. So here is your home, here is the temporary work location. If you have a regular or main job inside your metropolitan area, you can claim all expenses associated with travel to a temporary work location inside or outside of your metropolitan area as long as the assignment is temporary, that is expected to last a year or less. But if you travel from home to a regular second job, that is a job that is not temporary, then those costs are never deductible. But if you travel from your regular job to your second job or vice versa, then that expense is always deductible. And if you travel from your regular job to a temporary work location, that cost is also always deductible. So what is a second job? Well, if you regularly work at 2 or more places in one day, whether or not for the same employer, you can deduct your transportation expenses of getting from one workplace to another. If you do not go directly from your first job to your second job, you can only deduct transportation expenses of going directly from your first job to your second job. You cannot deduct your transportation expenses between your home and second job on a day off from your main job. So let's take a look at this table for what is deductible and what is not. We have deductible local and non-deductible. What is deductible includes commuting from one job to another job in the same day, and here we see that, regular job to second job, that is deductible. Fees for parking while attending a meeting away from your normal work location are deductible. You can claim the cost of putting an ad on your car. You can claim the cost of operating a for-profit carpool which you operate as a business, and you can also claim added costs you pay because you haul tools or instruments to work, such as renting a trailer. So what's non-deductible? Well, you cannot claim the cost of commuting to and from your regular job, nor can you deduct fees for parking while you are at work. You can claim costs for parking if you travel away to a temporary place to attend a business meeting, for example, but the actual cost of paying to park while you're at work is non-deductible. And by the way, many clients will present the cost of parking as a deductible item or an item that they think they should be able to deduct, and it's your job as the preparer to establish whether that parking was for basically commute to and from work or whether it was for a true business trip. Also, if you put advertising displays on your car, the cost of the advertising display is deductible, but it doesn't create a business use of the vehicle itself, and any costs associated with owning and operating that car have to be tracked separately, and the deductibility of costs associated with operating that car are going to be something we're going to be discussing next. You cannot claim the cost of your share of a carpool expense that you pay to travel to and from work. So if it costs you $5 a day to join in a carpool, that's going to be non-deductible. The fact that you haul tools or instruments to and from work does not mean that you are using your car for business purposes. And union member trips to a union hall, commuting expenses from the union hall to your place of work are not deductible. And this is one that I have come up fairly often. I have tax clients who are members of unions, and they go to the union hall each day to get their work assignment, and then they travel from the union hall to their work location. And IRS has specifically said, no, you can't claim that. So let's take a closer look at parking. The fees you pay to park your car at your place of business are non-deductible commute expenses. You can, however, deduct business-related parking fees when you visit a customer or client or attend a meeting away from your normal work location. So what are allowable car expenses? Well, if you use your car for business, you can claim your actual cost of operating the vehicle, or you may be able to claim a standard mileage allowance. Whichever method you choose, you must keep adequate records to prove your business use. How do you keep adequate records? Well, you do that in the form of a mileage log. The mileage log should show the date traveled, the place you traveled to, and the distance traveled. Obviously, the business reason would be necessary as well. You can claim a standard mileage rate, and that rate for 2010 is 50 cents a mile. It was actually higher in earlier years, 55 cents a mile in 2009, and it was up to 58.5 cents a mile for certain parts of 2008. It is, I believe, 51 cents a mile for 2011. I have to look that up for you later. But the standard mileage rate does change every year and is adjusted for inflation as well as gas prices. And gas prices did drop in 2010, which is why the mileage rate dropped. The following rules apply if you want to use the standard mileage rate. You can claim the standard mileage rate instead of the following: depreciation, gas, insurance, lease payments, licenses, oil changes and other maintenance costs, registration fees, repairs, and tires. Now, you have to choose the standard mileage rate the first year you use your car for business. If you choose to claim actual expenses, such as those listed here, in the first year you use your car for business, you could not generally turn around and then start claiming the standard mileage rate after that. So if you want to use the standard mileage rate, and I do usually encourage my clients to use the standard mileage rate, you have to make that election in the first year that you acquire the car. Now, if you claimed actual expenses on a car that you lease rather than you own, you cannot claim the standard mileage allowance in a later year. If you choose the standard rate, you cannot claim actual costs for operating your car in the same year. And even if you claim the standard mileage rate, you can still claim allowable costs for parking and tolls. You cannot claim the standard mileage rate if any of the following is true, however. Number one, you use your car for hire, such as a taxi, or you operate 5 or more cars at the same time in your business, because if you do, you are considered to operate a fleet, and then you must claim actual expenses. Also, if you claim depreciation deduction on the car in an earlier year, you are not allowed to claim the standard mileage rate this year. This has always perplexed me somewhat because depreciation is essentially a mandatory thing. You are required to claim depreciation when you are claiming expenses for depreciable assets. And so to have claimed actual car expenses but not claimed depreciation, well, that would be rather silly. Most people would claim depreciation on their car. So if you claimed actual expenses, it automatically follows that you should have claimed depreciation. And if you did, you cannot revert to the standard mileage rate in a later year. Under those same rules, if you claimed a Section 179 deduction or special bonus depreciation for the vehicle in an earlier year, then you cannot claim the standard mileage rate this year. Also, if you are a rural mail carrier who received a qualified reimbursement, you are not allowed to claim the standard mileage rate. And if you claimed actual expenses after 1997 on a leased car, that is another reason why you cannot claim the standard mileage rate. Now, when claiming the standard mileage rate, you will multiply the number of business miles driven by the standard mileage rate. For 2010, the rate is 50 cents per mile. For 2011, the rate increases to 51 cents per mile from January 1 through June 30th, and 55 cents per mile from July 1 to December 31. So if I was going off the top of my head for 2011 and not sure, well, the reason is it's actually you have two rates in place for 2011. It is not at all common for the IRS to have two rates in place in any particular year. It seems like almost every other year they do that to us. And as tax preparers, it just makes our job that much harder. It means when our client comes to us with total mileage for the year, we're now going to have to tell them for 2011 how much of the mileage was before July and how much of the mileage was after July, because we're going to have to apply two different rates for the year. So what can you claim if you are using actual car expenses? You can claim the actual cost of using your car for business purposes, and allowable expenses include depreciation, car rent and parking costs, gas, oil, and maintenance, insurance, lease payments, license and registration fees, repairs and replacement tires, and tolls. But even if you claim actual expenses, you must still track the number of business miles you drive so that you can prorate your costs between business and personal use. Now, it's not at all uncommon for me to have a client who says to me, I just want to use the actual cost of operating my car this year because I don't want to have to keep a mileage log. And they associate a mileage log with claiming the standard mileage rate. But the actuality is that whether you claim actual expenses or the standard mileage rate, you still have to keep a log. And here's why. You drove your car 15,000 miles during 2010, and 10,000 miles are personal, 5,000 miles are business. Well, the only way you're going to know that is if you keep a log to track it, right? And your actual cost for operating the vehicle totaled $7,000 for the year. You're going to be able to figure your actual allowable deduction as follows. 5,000 business miles divided by 15,000 total miles times the actual cost of the vehicle, and that gives you a deduction of $2,333 for the year. Business versus personal use on your car. If you use your car for business and personal use, you must maintain adequate records to show your business use. Acceptable methods of tracking business use include keeping a mileage log, and the log should record the following: the dates you traveled, the places you traveled to, the miles driven, and the reason for your travel. Also, your personal calendar of appointments to log miles driven for your appointments could be used. So you can keep an actual mileage log, or you can keep a calendar. It's been my observation in IRS audits, the auditor does not really care what format your log is in. They don't seem to care how you tracked your mileage. What they care is that you did track it. And I've been through several audits in recent years. The first thing the auditor asks for is the mileage log. If you don't have one, they throw out the deduction. But if you have one, they don't seem to care how you got it. If you present the mileage log, they add it up, and they tend to allow the deduction. Obviously, if you have a completely fake log with completely outrageous numbers that are not supportable in any way, they could question that. But I've personally had clients that I thought had fabricated their logs after the fact. I didn't ask them if they had, but it was self-evident to me that they probably had just by their behavior, and they presented those logs to the auditors, and the auditors accepted them. So this is by no means an encouragement to tell your clients to just make something up because the IRS auditor will accept it. That's actually unethical. But it certainly is appropriate to tell your client that the auditor will accept any kind of reasonable log you present, and if your client comes forth and presents a reasonable log, they'll take that. Now, on more than one occasion, I've been presented with a client who is being audited by the IRS, and they didn't keep a mileage log, and they told me that they hadn't. But we were able to sit down and reconstruct a mileage log from other records that they had. And we did map quests to track mileage distances. We used particular dates and time where they could prove that they were away from home. And obviously, you can't get to Seattle from Portland, Oregon without driving or flying. And so ultimately, because we were able to reconstruct these logs afterwards using reasonable methods, the IRS auditors allowed that. So I want to encourage you to make sure your clients are keeping logs, to just hammer in that the log is a requirement. But if you end up in a situation where you have a client who is being audited and they didn't keep a log, don't just give up. It is worth putting the time in because the mileage rate is such a huge deduction. If, for example, you have a client who drove 10,000 business miles during the year, and it's not at all hard for a salesman to drive 10,000 business miles in a year, then the standard mileage rate of 50 cents a mile would give you a $5,000 deduction. And you don't want to throw out a $5,000 deduction without a little bit of effort. So, you may use actual expenses or the standard mileage rate in any year. However, generally, you will not be able to claim the standard mileage rate in any year following a year where you claimed actual expenses and claimed depreciation on your vehicle. In most cases, this means you cannot claim the standard mileage allowance in any year after a year you claimed actual expenses for that same car. Now, what about interest on car loans? Well, employees are never allowed to deduct the cost of interest as an employee business expense. Interest on a car loan is considered to be personal interest, and personal interest is never deductible on Schedule A. And when we're talking about employee business expenses, those are deducted on Schedule A. And Schedule A allows only certain types of interest to be deducted, and they include mortgage interest and investment interest. That's essentially it for interest. So it is considered to be the case that interest on a car loan doesn't fall into either of those categories and is therefore non-deductible to an employee. However, if you are self-employed, you can claim the cost of interest on your car loan as a business expense on Schedule C. So I just wanted to point out while I'm at this point that all of the rules we've been talking about regarding the deductibility of business expenses are the same rules whether you are filing 2106 on Schedule A as an employee business expense, or whether you are claiming these expenses on Schedule C as a sole proprietor. The rules are identical until we get to this rule about interest on car loans. And if you are an employee, then the interest on a car loan is never deductible, but if you are self-employed, then you would figure the proportionate amount of interest on your car loan that you can show is attributable to business use of your car, and that is allowed as a prorated amount on your Schedule C. Now, if you sell, trade in, or otherwise dispose of your car, you do need to report the transaction to the IRS. Whether you claim the standard mileage rate or actual expenses, you will be treated as if you claim depreciation on your car. And if you dispose of your car, you must report the sale or disposition on Form 4797, Sale of Business Property. Your reason for disposing of the car does not matter. And here are some illustrations. Jan sells her 1998 Ford Taurus for $3,000. Since Jan previously claimed a deduction for business use of her Taurus, she will need to report the sale of her car on Form 4797. But let's just change the situation a little and say, well, Jan didn't sell the car, she totaled it. The vehicle was not insured, and she received no payment for the scrap value. Since Jan previously claimed a deduction for business use of her Taurus, she must report the disposition of her car on Form 4797. And Form 4797 will fall after the midterm exam for this course. We're going to discuss it when we get into the sale of business assets later on in the course. Record keeping. Record keeping is absolutely crucial. Anytime you ever have a client who's claiming a deduction of any kind and they get audited, the IRS is going to demand records, and they have to be good. And if your client looks like they made them up, or if they're partial or really unverifiable, the IRS is not going to allow them. So you must keep accurate records to prove that you paid expenses. And here are some of the important record-keeping tips that you should keep in mind and advise your clients on. If you are claiming business expenses, you will need to keep records. It is wise to charge your gas and other business expenses to a different credit card than the credit card that you use for personal expenses. This way, it is easier to track and separate business expenses from your personal expenses. One idea I give to clients is to keep an envelope in your car where you can store your receipts as you require them. As soon as possible, file your receipts in an organized manner, because remember that lost receipts equal lost deductions. Also, a canceled check, bank statement, or credit card statement by itself is not considered to be adequate evidence of an expense. It should be accompanied by a receipt or other form of documentation. So we've figured out what's deductible, what's not. Now let's go about claiming the deductions. So how do you report your employee business expenses? Well, sometimes you can claim the expenses directly on Form Schedule A, but more often you do need to enter the deductions onto a separate form, Form 2106. If you are required to, then you complete Form 2106 or a short version, 2106EZ, and attach it to the return. The form is required anytime you have auto, meal, entertainment, or travel expenses. Also, you should pay attention to whether you are operating under an accountable or non-accountable plan. If your employer reimburses you for your expenses, you must determine whether you are operating under an accountable or a non-accountable plan. Under a non-accountable plan, your employer will give you an allowance for your expenses with no requirement to report your expenses back. If this is the case, then you are under a non-accountable plan. So let's just suppose you work in sales and your employer gives you a flat expense allowance of $500 a month. You use the money in any way you want, and in a month where you pay more, you're going to have to use your own funds. And in an amount where you pay less expenses out, your employer allows you to keep the difference. You're just simply not responsible for reporting expenses back to your employer. Well, if that's the case, you are considered to be operating under a non-accountable plan. And under a non-accountable plan, your employer should include your allowance in Box 1 wages of your W-2. And you should, in turn, report all of your employee business expenses on Form 2106 as if you were not reimbursed at all. But under an accountable plan, then you are required to report your expenses to your employer, and your employer subsequently reimburses you for them. So what happens under an accountable plan is, let's just suppose your employer gives you that same $500 to pay expenses, but you have to report back and return in receipts, actual proof of those expenses to your employer. And at the end of the month, if you spent less than your employer gave you, then you have to refund it back to your employer. That would be the definition of an accountable plan. So under an accountable plan, you should not report your expenses and reimbursements on Form 2106. Unless your allowable expenses were greater than your reimbursements. If your reimbursements are greater than the allowable expenses, you are required to return any excess amount. And if the excess reimbursements are not returned, then your employer is required to report the excess unreturned reimbursements in your income as Box 1 wages. If your reimbursements are less than your actual expenses, you can claim the unreimbursed expenses as a deduction on Form 2106. And here is an illustration. Sally Smith is a union representative. Her employer gave her a $200 monthly auto allowance and reimbursed her 2,500 commute miles and 20,000 total miles. Her round-trip daily commute was 10 miles. Sally also spent $500 on deductible entertainment expenses. Her employer reimbursed her $250 for these expenses. Since Sally is given an allowance and she is reimbursed, she is on both an accountable and an unaccountable plan at the same time. The $200 allowance is paid to her regardless of the number of miles she drives. She is not required to refund the excess. The allowance is provided under a non-accountable plan. But the 14-cent per mile reimbursement is paid only when Sally submits receipts and a monthly expense report. The reimbursements are provided under an accountable plan. So Sally should report her reimbursements on Form 2106 as shown next. And here is Sally's Form 2106. We show in line 1 the amount of mileage deduction she is allowed to claim using the standard mileage rate. She drove 14,000 miles. She multiplies that by the standard mileage rate of 50 cents a mile and enters the total, $7,000 on line 1. We also told you in the wording of the problem that she had $500 of meal expenses. We enter those meal expenses in column B. And we then go down to step 2. And on line 7, she reports the reimbursements that she received from her employer. And we've told you that her employer reimbursed her at a rate of 14 cents a mile, so we're going to go 14 cents times 14,000 miles. That gives us $1,960 we enter as a reimbursement under column A. Her employer also reimbursed her $250 for meals, and we enter that in the meal column. We then subtract reimbursements for her mileage amounts from the actual deduction she figured for herself up here, and the difference is allowed to her as a deduction on Schedule A. That's $5,040. We do the same formula for the meals. We start with $500 of meal expense, subtract out the $250 that the employer reimbursed her, and that leaves her with $250 for meal expense that she has net, but now we have to apply the 50% limit, so her deduction is limited to $125. We add $125 to $5,040, and we get her total employee business expense deduction that will carry over to Schedule A. And there is some additional information that is called for on Form 2106, and this is mileage information. I need to point out that this information is not optional. It has to be completed, and the IRS is pretty snoopy. Essentially, they want to know when you acquired the car and started using it in your business. They want to know how many miles total you drove it for the year, the number of business miles you drove it for the year, the percentage business use, the round-trip daily commute, and the total commute miles and business miles that were driven, or other miles that were driven. I'm going to just pull up another full screen of Form 2106 right here. So this Form 2106 that I'm showing you is actually a cutout. We have a cutout from page 1 of 2106 here, and down at the bottom we have a cutout from page 2 of 2106. So let's just take a closer look at the form itself. You'll see here in Part 1 we enter the business expenses. We enter vehicle expenses from page 2 of the form on line 1, and we enter parking fees, tolls, and other transportation expenses on line 2. Travel expenses while away from home overnight, including lodging, airplane, car rental, etc., go on line 3. Business expenses that are not included on other lines go on line 4, and an example might be union dues or education costs that you would enter on line 4. In Part 2, you enter the reimbursements from the employer, and we then go over to page 2 in Part 2 where we enter the auto information. So let's take a look at a summary here of how and when to claim expenses and reimbursements on Form 2106. Okay, here is a chart that does a summary of how and when to claim your expenses and reimbursements with respect to 2106. In a nutshell, this is how it works. If your employer has an accountable plan and gives you an allowance and you return any excess to your employer, no amount is included on your W-2 and no amount is reported by you on Form 2106. But if you have a situation where your employer is giving you money to pay your expenses and you're required to return any amount you don't use to pay expenses, but you don't return that amount, then the amount you should have returned and did not has to be included in your W-2 as wages. And you would not file Form 2106 in that situation. There could also be a situation where your employer is giving you a per diem or mileage amount up to the federal rate. And if they do that, then they don't report it in your W-2. And at the same time, you would not normally need to file Form 2106. But if your employer gave you less than the federal rate, you could file 2106 to claim the difference between the federal rate and what they reimbursed you. In certain situations, there could be a per diem or mileage allowance that is up to the federal rate, and as long as they don't give you more than the federal rate, then you don't need to include any excess in your income. But if they give you more than the federal rate, or there is a requirement to refund back to them any excess and you fail to do so, then any amount above and beyond the federal rate has to be included in Box 1 as wages, as well as in Box 12 of the W-2. You would not file Form 2106. Now, sometimes you're working under a completely non-accountable plan. As I described earlier, your employer just gives you an allowance. There's no requirement to report back. And if they do that, they're going to report the full amount in your W-2 as wages, and any allowable amounts you have to claim for the year are claimed in full on Form 2106. So the next topic we're going to look at is statutory employees. If the statutory employee box is checked on your W-2, you should claim your employee business expenses on Schedule C instead of on Form 2106. So I've got a W-2 here that I've opened up, and I just wanted to point out the statutory employee box. It appears right here, Box 13. And if you have the statutory employee box checked on your W-2, then you claim your expenses on Schedule C instead of on Form 2106. Statutory employees can include individuals who are employed in the following occupations: certain agent and commission drivers, full-time life insurance sales representatives, certain home workers performing work according to specifications furnished by the person or organization for which the services are performed, certain traveling or city sales persons working full-time, except for sideline sale activities for one firm or person soliciting orders from customers. If you meet the definition of a statutory employee, your employer must indicate this classification by checking box 13 on your Form W-2. This tells the IRS that you have the right to report your expenses on Schedule C. By claiming expenses on Schedule C, a statutory employee is not subject to the 2% limit and does not need to itemize deductions. As a statutory employee, you are considered an employee for Social Security and Medicare purposes. However, if you and your employer agree, federal income tax withholding is optional rather than mandatory. A statutory employee reports his or her wages from Box 1 of Form W-2 on Line 1 of Schedule C. He or she then deducts the allowable expenses in Part 2 of Schedule C to arrive at the reportable income to be entered on the tax return as wages. And we're going to take a detailed look at Schedule C after our midterm exam later on in the course. Self-employed persons, if you are an independent contractor or if you are a self-employed, you should claim your business expenses on Schedule C. Do not use Form 2106 or 2106EZ. So let's move on to the next topic, which is work-related education expenses. You may be able to claim work-related education expenses as an adjustment to income, or as an education credit, or as a miscellaneous itemized deduction on Schedule A. To be deductible on Schedule A, your education expenses must be required by your employer to keep your present salary, status, or job, or serve a bona fide business purpose, or maintain or improve skills needed in your present line of work. Even if these tests are met, you cannot claim a deduction for your education costs if they are needed to meet the minimum education requirements of your present trade or business or are part of a program of study that can qualify you for a new profession. Now, I did want to point out that work-related education expenses do not need to go on the Employee Business Expense Form 2106. It is possible to report those directly on the Schedule A, and if you were to enter them on Schedule A, you would enter them on line 21. So Form 2106 is required when you are dealing with employer reimbursements, when you are claiming travel, meal, or entertainment expenses. But if the only expense you had for your job was work-related education, you could enter that expense directly on line 21 as an education expense. And what we've talked about here is that earlier in the course when we were talking about itemized deductions, we discussed when you could claim a tuition and fees deduction. So that's one way to claim education expense. Another way to claim education expense is as an education credit. And a third way to claim an expense is as an itemized deduction here on Schedule A. But if you claim your expenses on Schedule A, you're subjected to some very specific rules, and the rules are different than the rules for the education credit, and they are different than the rules for the tuition and fees deduction. So you may have a client that qualifies to claim their expenses as an education credit, as a Schedule A deduction, and as a tuition and fees deduction, and you're going to have to choose the method that benefits them the most. So, in order to claim the expenses on Schedule A, the expense must be required by your employer to keep your present salary, status, or job, or serve a bona fide business purpose, or maintain or improve skills needed in your present line of work. Even if these tests are met, you cannot claim a deduction for your education costs if they are needed to meet the minimum education requirements of your present trade or business, or are part of a program of study that can qualify you for a new profession. You may still be able to claim these types of education costs as either a tuition and fees deduction or as an education credit. You may be able to claim education expenses in more than one way. You may qualify to claim certain higher education expenses as an adjustment to income on 1040 or as an education credit. If you qualify to claim your education expenses in more than one way, you should choose the method which benefits you most. You may not, however, use the same expenses as both employee business expenses on Schedule A and as an adjustment to income and or an education credit. So remember the rule, no double deducting. Also, there are some special rules in place for teachers. If you are a teacher, the following rules apply. Once you are considered to be a teacher under the rules for your state, additional education required by the state to keep your job shall be considered qualifying education for purposes of Schedule A deduction. Once you have met the minimum education requirements for your state, you are considered to have met the minimum education requirements for all other states you later go to work in. So under the earlier rules we described up here, If you move to a new state and you arrive in a new state and your new employer says, we'll hire you, but you need to go through these education expenses because this state has higher standards, then because you're meeting the minimum standards of the new state, then they're not deductible. But for teachers, that rule does not apply. If you meet the minimum standards in your home state and then you move to a new state, then if the new state says you have to get more education to meet their standards, IRS is saying you can deduct those qualifying expenses even if they are meeting the minimum standards for the new state because you are a teacher and teachers are special. All teaching and related duties are considered the same general kind of work. A change in duties in any one of the following ways is not considered to be a change to a new business. Elementary school teacher to secondary school teacher, teacher of one subject to teacher of another, classroom teacher to guidance counselor, and classroom teacher to school administrator. None of those are considered to be a change of career. How do you claim your educator expenses? If you are an educator, that is a teacher, then you can claim expenses as an adjustment to income as well as on Schedule A. If your educator expenses combined with your other allowable miscellaneous deductions total less than 2% of your AGI, you should claim your educator expenses up to $250 as an adjustment to income on Form 1040, line 23, or on 1040A, line 16. But if your expenses are more than 2% of your income, you should subtract $250 from your allowed expenses, enter $250 as an educator expense, and then claim the balance on Schedule A. You could also claim the entire amount on Schedule A, but you can nudge that 2% limit amount down ever so slightly by reducing your adjusted gross income if you claim that $250 as an adjustment to income. So what educational expenses are deductible? Well, you can claim deductions for the following expenses, and these are broader categories than we see under the tuition and fees deduction or under the education credits that we'll explore later in our course. If you are claiming education expenses on Schedule A, you can claim the cost of tuition, books, supplies, lab fees, and similar items, as well as certain transportation and travel costs to and from school. Other educational expenses such as research costs, typing costs, etc., and transportation costs are deductible if you are going to school on a temporary basis, that is 1 year or less. You can deduct the cost of traveling from work to school and from school to home. But if you are going to school for more than a year, you can deduct the cost of going directly from work to school only. You should claim your unreimbursed educational expenses as you do other unreimbursed business expenses. Generally, you should claim your expenses on Form 2106 or 2106EZ. However, you do not need to file Form 2106 if you were not reimbursed for any of your expenses and you are not claiming travel, transportation, or meal expenses. If you are not required to file Form 2106, you can claim your qualifying education expenses directly on Schedule A, line 21. And here is an illustration. You paid $6,000 for tuition and other college fees related to your current occupation. You are not claiming any automobile expenses, and your employer did not reimburse any of your expenses. You are not required to file Form 2106, and you can report your employee expenses directly on Schedule A, line 21. Form 2106EZ, you can use Form 2106EZ instead of the long Form 2106 if you were not reimbursed for any of your expenses and you are using the standard mileage rate if you are claiming auto expenses. Home office is the next topic. To claim an expense for office use of home, you must have a part of your home that is set aside for regular and exclusive business use, and you must maintain your home office for the convenience of your employer and not just as a convenience for yourself. Also, the office must be your principal place of business for your trade or business, a place to meet or deal with your patients or customers in the normal course of your trade or business, or a separate structure that is not attached to your home, which you use in connection with your trade or business. Although there is no office use of home form for employee business expenses, you should still complete a worksheet or use the IRS Form 8829 as a worksheet so that you have a record of how you calculated your deduction. We will cover home office expenses in depth in our session on self-employment, and the reason we're reserving it for our discussion of self-employment is that the restrictions on home office deductions for employees are well, they're very restrictive. And because they're restrictive, very few people who are employees ever get to claim a home office deduction. But the home office deduction is much more flexible and is more frequently allowed under the self-employment rules. And so we'll cover it when we get to that part of our course. So that concludes the Session 8 lecture. It's now time to do some classwork assignments. The first classwork assignment is for Edward Scissorhands. He is single, and he lives in Paramount, California. He did not pay mortgage interest or real estate taxes during the year. Edward was naughty and did not have any state taxes withheld by his employer. His adjusted gross income is $30,000. Edward owns a 2003 Dodge Caravan, which he uses for his work as a landscape artist. He first began to use the vehicle for business on 1/1/05. Edward claimed the standard mileage allowance last year. This year, Edward drove the van 30,000 miles, of which 5,000 were commute miles, 13,000 were business miles, and 13,000 were personal miles, and 12,000 were business miles. He had the following expenses. So we've got a list of all of the expenses shown here. Figure Edward's allowable auto expenses using both the standard mileage rate and actual expenses, and then answer the question. Is Edward better off claiming actual expenses or the standard mileage rate? Also, during the year, Edward flew to King County, that's in Washington, where the per diem rate is $71 per day, to attend an advanced gardening class. He was there for 2 full days and had the following expenses: tuition and supplies, airfare, meals, hotels, and taxi. Prepare Edward's Form 2106 and his Schedule A for his auto expenses. Use whichever method gives him the best deduction. So that is classwork A. So please push pause at this point. Prepare those 2 forms for Edward, that is Schedule A and Form 2106, and when you are finished, please resume playback for a review of the answer key to classwork number 1. So here we have the classwork 1 answer key. Edward put 30,000 miles on his van during the year, and the total business miles were 12,000. Using this information, we need to calculate Edward's business use percentage, and here's how we do it. We take the 12,000 business miles, divide those by the 30,000 total miles, and we get 40% business use. If Edward uses the standard mileage rate, he would take 12,000 business miles and multiply that by 50 cents a mile to get a deduction of $6,000. If he claims actual expenses, he would add up all of the expenses as follows: gas, new tires, repairs, AAA membership, car wash insurance, and lease payments, and he gets a total amount of $13,145. He then multiplies that by 40%, and he gets $52.58. That's less than the standard mileage allowance. Therefore, we're going to use the standard mileage allowance when we prepare his forms. The toll and parking expenses are not included with auto expenses because they can be claimed in full, and they are not prorated based on business use of the vehicle and are not a part of the standard mileage rate. We include parking and toll expenses on line 2 of Form 2106, not on line 1 with other auto. So here is the Form 2106. On line 1, we enter the standard mileage rate that we figured for the car. On line 2, we enter the parking and toll. So you can see here we have the $145, and we entered that on line 2. And then on line 3, we've entered the travel expenses, where we have airfare, hotels, and taxi. And when you add those 3 numbers up, you get $800. Then on line 4, we enter other expenses that he had, which include tuition and supplies, $1,500. The $150 that he has for meals is actually, the actual expense is more than the per diem rate. So we went with the actual rate here and entered that under column B, $150. The next step, he had no reimbursements, so step 2 is blank. Then in step 3, we figure his limits, and we apply a 50% limit to his meal expense. We add line 9A and line 9B, and we get a deduction on line 10 of $85.20 that will carry to Schedule A. Remember, on page 2 of Form 2106, we have to answer the auto expense questions and also answer questions 18 through 21, so we've checked our answers there. And here is Edward's finished Form 2106. You can see that his actual total itemized deductions have to be reduced by 2% of his income. His income is $30,000. 2% is $600. So ultimately, his deduction is limited to $79.20, down from the $85.20 we showed on the 2106. But that's still more than the standard deduction, and so he is better off itemizing his deductions. Going back to the manual to classwork assignment number 2, which of the following taxpayers is eligible to use the standard mileage rate? Let's take a look at these. Tom claimed the standard mileage rate in 2008 when he placed his car in service. In 2009, he claimed actual expenses, which included depreciation. Tom did not use any other cars for business during 2010. What I'd like you to do is go through, read questions 1 through 4, answer yes or no to each. When you are finished doing this particular part of the assignment, please review playback of the video for a review of the Session 8 Classwork 2 answer key. And if you would like to go open up that answer key for playback of the video, the password to open that is ZORSE. That's ZORSE. That is the final password I will be giving you today. So please push pause now, do the classwork assignment, and then resume playback for a review of that answer key. So for review of classwork 2 answer key, the first problem involving Tom, his standard mileage rate in 2008 when he placed his car in service, or he claimed the standard mileage rate. Then in 2009 he went actual. So what is he allowed to do? Well, since he claimed actual in 2009, including depreciation, he is not allowed to claim the standard mileage rate in any later year, so Tom will be forced to use the actual expenses in 2010. Charlotte Mays leases her car. She uses only one car for her business. 2010 was the first year she drove her car for business. Can she use the standard mileage rate? Yes, the answer is she can. Number 3, Louis is a cab driver. 2010 is the first year he used his car for business. No, he cannot claim the standard mileage rate because his vehicle is used for hire. Finally, Betty is a delivery driver. She claimed the standard mileage rate in 2009. It is the first year she used her car for business. Is she allowed to use the standard mileage rate? The answer is yes, she can. So that concludes the Session 8 lecture and classwork review. Your homework assignment involves preparation of a tax return for Jonathan Livingston. It includes Form 1040, Schedule A, and Form 2106. We're providing you with the usual information, his W-2, and of course a whole list of expenses, actually multiple W-2s here, a whole list of expenses that you'll need to go through in establishing what his itemized deductions are, and we are describing those in the verbiage of the problem here. So thank you for joining us for Session 8. I'll see you at the beginning of Session 9, where we will, of course, begin with a review of the Session 7 quiz answer key. Bye-bye.